Stocks are rallying again Tuesday, despite the 10-year yield piercing 2%. Here to talk about whether or not that rally is going to rage all summer is Alec Young. He's the global equity strategist at S&P Capital IQ. Welcome, Alec. And tell me, do you stick with stocks for the summer because the month's not over and you can still sell in May and go away?
Yeah, I mean, I think we've seen a big rally here year to date, and while we think you can justify, building on this rally later this year, as we get more comfortable with stronger growth next year and the earnings outlook accelerating into 2014. I think for now we expect stocks to be kind of range bound over the summer. We've had a tremendous move, and over the near term, next couple of months, we think stocks are fairly valued.
The S&P is up 18% year to date. Healthcare stocks, however, are up 25%. What's your view on these? Have they gotten too expensive?
No, we still like healthcare. We've been recommending an overweight to healthcare all year. It's the best performing sector in the U.S. market. We still like it. It's much cheaper than other defensive areas, even though the pharmaceutical stocks continue to offer attractive yields. And with interest rates still very low, we think dividend yield is an important theme this year. But you also get a lot of really nice growthy exposure in the healthcare sector with things like biotech and life sciences, medical devices. So it's a nice way to get some defensiveness along with some more cyclical exposure all in one area.
Two other sectors that have done very well so far this year are financials as well as consumer staples. Both of them have returned over 20% year to date. Do you stick with these two sectors?
I think you're referring to consumer discretionary and financials, and we have been overweight consumer discretionary all year. It's the third best performing sector behind healthcare and financials. We like the idea of having some cyclical exposure because we do see our economy continuing to accelerate through the summer, into the fall, and into 2014. And we think there's less risk to the U.S. recovery than a lot of the potential headwinds we're seeing in Europe and places like China. So we like the more domestic cyclicals. We think consumer discretionary fits that theme really well. We got another report on Case-Shiller on housing strength, a good consumer confidence number today. All these things tend to play into the retail outlook, the leisure outlook. So we like consumer discretionary. Financials, we've had a neutral view on this year, and I guess you could say we've missed the outperformance, but I think we're more comfortable with healthcare and consumer discretionary right now on the overweight side.
Finally, dragging down the S&P, I guess if you can call it that, is materials. This sector is only up 9%, which normally would be pretty good for half a year, not even half a year. What's your view of materials? Commodities really have been coming down.
Yeah, I think we're underweight materials. That's worked pretty well for us. We have seen a rotation into more cyclical leadership in the last few weeks, but materials has been a bit of the odd man out. I think the problem there is continued negative economic news coming out of China. No real sign of stabilization in terms of their slowdown, and obviously China's a big marginal demand driver for a lot of the world's big commodities. So materials is an area that we'd continue to underweight right now.
Thanks a lot, Alec.
Thank you.